The Financial Planner, presented by BSC, Investors Protection Fund.
Hello and welcome to this episode of Financial Planner. Today, the lessons that we are going to learn today is a very, very critical lesson because this show essentially is meant for retail investors, and what we are going to tell you is an important and a critical way that retail investors can choose as far as investing in equity market. For series, we've told you about how you need to be an informed investor and invest in equities market. But now we are talking about mutual funds, the route that you as a retail investor can choose. So what really are mutual funds? In the couple of episodes going forward, we will be taking you in detail and telling you in detail and in depth about the aspects of mutual funds and what you should know about mutual funds and help in terms of investing in equity market. Well, that's the topic that we start with today with our special guest, Hemant Rustagi. Thank you so much, Hemant, for joining us. And of course, like always, we will be addressing your financial queries and any queries that you send in to us and email to us. So let's begin the show, Hemant. And, mutual fund, we have repeatedly, continuously mentioned about how critical and important that is as a route to get into investing in equity markets. What really is a mutual fund?
Well, mutual fund is an investment vehicle that allows investors to invest in different markets. For example, there are equity markets, there are debt market, there are, gold. What happens is you have option of either going and investing directly into these markets, or you choose an investment option where, like you, there are thousands, even lakhs of investors pool their resources and allow the professional and the fund managers to manage your money. So I think it's a very, very efficient investment vehicle, and I think today it suits the needs and requirements of every kind of investor.
So essentially, an investor has an opportunity, even if he doesn't have time to, to spend on, analyzing, understanding what is right, what is not. You basically put your trust onto somebody who's an expert to manage your money.
Oh, absolutely. That is what a mutual fund does. There are full-time professionals who manage your money. They are backed by the research analysts. They really understand what the markets are, what is the different aspects of economic event or other political event, the impact of that on your portfolio. If at all some changes have to be done, those changes are done, which as an investor becomes very difficult for you because you neither have the wherewithal or the time to actually keep track of different events that can affect your investment in the markets.
Okay, let's go through about understanding what are the different benefits of investing in NAV, because any investor would want to know that what really I'm getting. You will be paying certain price for that expertise that you sort of ask your fund manager to do on your behalf. But what are the key benefits that mutual funds bring to table?
Well, I would describe mutual fund as a simple way through which you can get a diversified investment option as well as balance your investment risk. There are many advantages of investing in a mutual fund. It begins with regulations. It's a very well regulated industry. Mutual fund regulation, which basically are governed by SEBI, Security and Exchange Board of India, they very clearly spell out what a mutual fund can do and what it can't do. So it's a very well regulated industry, which is very good from investors' point of view because your money is protected if you have industry which is very well regulated. The second is it's a diversified investment option. Like I said, by making one investment, you buy into an already existing diversified portfolio, which means that if you're investing in an equity fund, and if you invest, let's say, 10,000 rupees, you end up actually investing in 50, 60, or even 70 stocks at a time, which is practically impossible for any investor to achieve that. And the second part of diversification is, like you, there are thousands, there can be lakhs of investors investing. So while market goes through different moods, you may or may not be able to invest when the markets are down or the markets when the markets are up. There are others like you who come in at different points, and I think you get the advantage of averaging because you become owner of that pool, which is what we call the mutual fund. Then there are professionals who are managing your money. Now these are the professionals who do full-time job as for managing your money. They are supported by research analysts who actually go and talk to the companies, the research companies. They keep a track of what's happening in the domestic market, in the global markets, the different events, what impact they can have on your portfolio. So you have professionals managing your money all the time. Then the tax efficiency is there. mutual funds are very, very tax efficient investment vehicle. That is very important. Let's take an example of somebody investing in equity market. Now, any investment that you sell after 12 months, okay, the long-term capital gain is tax-free for both. But if you were to make any changes within that period of 12 months, and if you're investing directly into the stock, you may end up paying short-term capital gain. In a mutual fund, professionals, the fund manager, do it on your behalf. And you don't have to pay any tax because you have not done any action. It is being done by the fund itself, and the fund is not liable to pay any tax. So it is much more tax efficient. On the debt side, if you really see, compare that with fixed income options, traditional options. These are much more tax efficient. So you have a whole lot of benefits which are available to you. And the liquidity, very important for an investor's point of view. Today open-ended funds dominate the mutual fund industry, which means that you can get in and get out at any point of time depending on your requirement.
Okay, when we are talking about benefits, we've illustrated, you've explained in depth about that, but about risks now, because we have to weigh both the sides. So what are the risks that one needs to be aware of when they're investing in mutual funds?
Well, there are certainly risks of investing in mutual funds because mutual fund invest in market-related instruments. And whenever you're investing in these instruments, obviously there is going to be some amount of risk. Now, what are these risks? These risks are market risk. Now, these risks refer to the factors that can impact the entire market or its asset class itself. Now, what are these risks? You have risk of inflation, which can impact an equity investment or debt investment. How it can do that? High inflation scenario means high interest rates, which affects the bottom line, which is not liked by the stock market. And then on the debt side, in a rising market, because there is an inverse relationship between interest rates and the bond prices, an income fund will not give you the kind of return it would give you in a falling interest rate scenario. So there are risks associated with inflation, interest rates, political scenario. It's very, very important because politicians are the one who actually rule the country and they decide as to which way the business can go. And there are so many other domestic and global factors which can have impact on the market. Then there are non-market risk. What are these risks? These risks are associated with what I would say an industry, a sector, or a company. Now, market risk obviously are much more broad-based. These are related to a particular sector or a particular stock. That is where it pays to have a diversified portfolio. When you invest in a sector-specific fund or stocks, and if there are changes in that particular sector or that stock, your portfolio can take a bigger hit as compared to a diversified fund. So there are these market risk and the non-market risk which investors have to deal with when they invest in mutual funds.
Okay, Hemant, I would not be doing justice to the viewers if I don't ask you, while we are discussing mutual funds, as a part of a lesson that we are going in terms of making most of our viewers informed investor. But in today's context, we are talking about when there is extreme uncertainty, gloomy atmosphere as far as investment equity markets are concerned. You look at every corner, a common man is hit by inflation, rising prices. The markets are not performing very well. In fact, perhaps we are one of the worst performing markets currently, in certain parameters. Then we are talking about, the rupee depreciation that is impacting for those who probably invest or outside, and that in turn is affecting various, commodities that we buy and all. In this context, when we talk about mutual funds, we also talk about, okay, the sentiment in market is impacting mutual fund and people are not coming in. As an investment in, a mutual fund, how important it is to continue sort of investing as in a regular, disciplined manner, irrespective of the volatility. What is the message that you would like to give to the viewers who are concerned, those who have invested and those who perhaps would be a little wary to enter the market at this point in time?
Well, I think if you're talking about equity market specifically, I think it's very, very important to consider 2-3 factors before you even start investing in equities. Equities are potentially the best investment option that one can have. At the same time, they tend to be volatile over the medium and short term. Now, the thing is, when you're investing in an asset class like equity, you have to have a long-term time commitment and also follow the discipline of investing on a regular basis. Why it is important? any investment option or any asset class that gives you the kind of return equities have given historically is bound to face volatility. Okay? Now, it is important for investors to understand and realize that when we invest in equities, it is not a one-time activity. It is a process. You are trying to build a corpus over a period of time. Don't come into equity for a short-term horizon because it can be very, very risky for you. When you invest for the long term, you are invariably going to face market conditions, situations like what we are facing today. We have faced that in the past. I'm sure we're going to face that even in future, where we'll see volatility in the markets happening on account of various factors. Some domestic, some international, sometimes both. What we need to realize that let us not judge an asset class by looking at its performance over the last couple of years. This asset class has the potential to deliver fantastic return if you have a time horizon of 10 years, 15 years, 20 years.
And that's what retail investors should be looking at.
Absolutely, because if you keep your focus on your long-term objective, I think it becomes very easy for you to handle this volatile period. And if you come in with realistic expectation, I think it's much more easier to handle the volatile period as compared to someone who just gets in because he wants to make money in the short term.
Well, there is no shortcut to making money. On that note, we'll slip into a short break, but we'll come back and address all your queries when we return.
The Financial Planner, presented by BSC Investors. The Financial Planner, presented by BSC Investors Protection Fund.
Welcome back to Financial Planner. It's that time that we take up your queries.
Investment Ladder, presented by BSC Investors Protection Fund.
Well, the first query, Hemant, that we've received is from Dr. Rahul. He's 30 years of age and has a 2-year-old son. He has about 1.5 lakh rupees in his hand and has started an SIP of 5,000 rupees in 4 mutual funds. And he wants us to suggest if he should put the money in liquid funds, and also wants to know the difference between liquid funds and debt funds. So to begin with, let's go and understand what really the difference between liquid and debt fund is.
Well, I think a liquid fund or any other income fund, if you were to compare these two, the difference would invariably only in terms of the maturity duration of the portfolio. Now, that is the tenure of the securities which are there in the portfolio. Now, what typically happens? What are these liquid funds? These liquid funds are meant to park your money for the short term, which means that it could be that you have a short-term money, or you're waiting for an opportunity in the market, or you want to keep the money aside for a particular objective. You are looking for an option where you can park this fund. That's where liquid fund come into picture. The other debt funds, so which means that when you talk about a liquid fund, the maturity duration generally would be around 91 days. Okay, it will actually invest in those money market instruments which have a residual maturity of 91 days, which means that the impact of interest rate volatility on this kind of fund is going to be negligible. If you look at other debt funds, there the maturity duration, depending on whether it's a short-term debt fund or a medium-term debt fund, could be ranging from 1.5 years, 2 years to as much as 7 years. Now, what investors need to realize that any portfolio which has a maturity duration of 5 to 7 years will be impacted much more by the interest rate volatility, which means that in good times it can give you much higher return than what these liquid funds can give you, and in bad times, those are the time when the interest rates are actually going up, they can give you much less than what a liquid fund would give you. So I think it's all about the kind of risk you want to take and the duration for which you want to invest. That is the basic difference between a liquid fund or a normal debt fund.
Now, coming to Dr. Rahul specifically as far as his investment, he's unfortunately not given us the details of his portfolio so that we could guide him on that as well, whether he's made right decisions or not. But overall, on the about other money that he's wanting to park into a liquid fund and then probably look at an STP, I think.
Yeah, I think if you look at his requirement for investing in liquid fund, what we need to understand, since he has not mentioned that, I'm assuming that there are 2-3 scenarios which can happen. One is that he wants to park his money, like I said, for some time. Liquid funds are a good option. There he can invest the money. There are 2-3 good liquid funds. In fact, before that, I would say that if he has a time horizon of a couple of months, let's say 3 months or even more, it will be better that if he considers ultra short-term debt fund. Now, these funds typically will have a maturity duration of 91 days to 180 days. They are much more tax efficient than liquid fund. What happens is when you invest for the short term, you have to choose the right option. If you choose a growth option, you end up paying short-term capital gain, which is not a smart thing to do. What one should do is should go for dividend reinvestment. Now, when you invest in liquid fund or ultra short-term fund, you should go for daily dividend reinvestment option, which means that the fund will pay a dividend distribution tax on your behalf, and the dividend that comes in your hand becomes tax-free. Now, if you look at DDT in case of a liquid fund, for an individual investor is 27.03%, whereas in ultra short-term fund is 13.52. So you can see the difference that if he belongs to actually high tax bracket 20% and 30%, he should go for ultra short-term if the objective is to park money for the short-term. But if the intent is that this money eventually has to go into equity, maybe he's waiting for the right time and right opportunity to invest, then there are two options. If he wants to invest the lump sum, then he needs to choose today which fund he would like to invest so that this money can be invested in the ultra short-term funds of those mutual funds. If the money has to be invested through STP, then again he has to first choose the equity fund where the money has to eventually go, and automatically then the money will be invested in the ultra short-term fund of those mutual funds. What typically happens in STP is that you have a lump sum money, but you don't want to commit money at one level. It's akin to SIP. In SIP, the money comes out of your bank account. Here you have a lump sum, which you have already invested. It comes out depending on what instruction you give it to the fund. So on a pre-decided date, a fixed amount is invested from an ultra short-term fund into an equity fund. So these are three scenarios which are possible. Depending on what fits for him, he should make a decision.
For the interest of viewers, I'll ask a very basic question that perhaps may be there in their mind, which is with regard to STP. So is it necessary that if, for example, you have chosen an equity fund of a particular fund house that you want to invest, you need to necessarily put in the liquid fund of the same very house? What is the rule?
Well, yes, it has to be. What is the objective of doing STP is that, like I said, you have a lump sum money. You do not want to commit the entire sum at a particular level. You want that money to be invested at different levels into the equity fund. Now, if you have, for example, let's take an example of, let's say you want to invest in HDFC equity fund. It is absolutely necessary that you invest in money, the lump sum money in the liquid plus fund of that mutual fund.
HDFC.
Otherwise, how do you transfer money? Every time you have to redeem the money, it is not going to be STP. Then it's a fresh investment, it's a one-time investment. So ideally, in STP, the money has to be invested in the liquid plus fund of the same mutual fund, where the money has to eventually go.
All right, well, on that note, we'll slip into another very short break, but we'll come back and again take up your queries when we return.
The Financial Planner, presented by BSC, Investors Protection Fund. The Financial Planner, presented by BSC, Investors Protection Fund.
Well, you're watching Financial Planner and we are talking about your questions and taking up your queries. Well, the next query, Hemant, that we have is of SK Alamuddin from West Bengal. He has given us his portfolio in detail. He set a target that he needs about, in 12 years around 15 lakh rupees and about 20 lakh rupees in 15 years. He already has about, 2 gold schemes and would perhaps need some health insurance and term policy. But let's look at his portfolio. He has invested through an SIP in couple of funds, which is HDFC Tax Saver, Magnum Tax Gain, UTI Energy Fund, UTI Leadership, Dividend Yield, HDFC Top 200, HDFC Equity, Reliance Gold, which he mentioned about. Apart from that, he also has invested in some policies like the LIC Jeevan Sathi, Endowment, Jeevan Saral, Bajaj Alliance, and he has one-time investment in HDFC Tax Saver, UTI Equity Fund, UTI Infrastructure Fund, Magnum Tax Gain, LIC Market Plus. So that's what his portfolio consists of. So many number of policies, insurance policies and mutual fund. Not prudent, right?
No, absolutely. I think too many funds, too many insurance policies, not good. We always keep talking about over-diversification is not good for any portfolio. But before I comment on the existing portfolio, let's begin with the target that he has set for himself. There are 2 targets that he has talked about. One is 15 lakh in 12 years, another one is 20 lakhs in the period of after 15 years. Now here the time horizon is very important, 12 years and 15 years. The second is he wants to invest regularly. So when you talk about this kind of time horizon, it's equity. Because
Yes.
equity, you need to then invest in asset class where you can beat inflation, which also gives you better return than other asset classes over that period. So I think here he should be focusing on equity and equity-oriented fund, which is what he has been actually doing already. What he needs to do is, I'm assuming annualized return of, say, let's say 12% here. He needs to invest 5,000 rupees to achieve his first target of 15 lakh in 12 years. And for the second target of 20 lakh in 15 years, he needs to invest 4,500, which means his total investment has to be 9,500. The key, of course, here is that you have a time horizon of 12 years and 15 years. There are going to be periods where you will wonder whether you're doing the right thing by investing in equity. You need to handle them with care. You need to stay invested during that period and follow the discipline of investment throughout this period. I don't see any reason why he cannot achieve his target if he does that. Right. If you look at his existing portfolio, there is nothing much we can do as far as the ELSS funds are concerned, because all these funds have a 3-year lock-in period. But I would like to tell him that I'm not too happy with Magnum Tax Gain, has not been doing well. But like I said, if he has not completed the 3-year lock-in period, there is nothing he can do at this stage. As for the other open-ended equity funds, where he is investing through SIP as well as lump sum investment, 3-4 funds he need to exit. One, there are a lot of funds from UTI which have not been doing well. I mean, these are UTI Energy Fund, UTI Leadership Fund, UTI Equity Fund, Infrastructure Fund. Now, you know, for someone who's trying to build a corpus through smaller contribution, I personally feel should stay away from thematic fund, sector fund. What you need is you keep your focus on diversified, good quality fund which have consistent performing track record. So if he exit from that, he can invest that money, reinvest that money into some of the existing fund. He has HDFC Equity, HDFC Top 200, or he can consider ICICI Focus Blue Chip Fund, which is a pure large cap fund. On the insurance front, like I said earlier, he has too many policies, and all these are basically traditional endowment policies. Now, these are not the policies which will give you the adequate risk cover. Okay, at best, I can look at them as a debt portfolio for a longer term. That's it, and the returns are very, very poor. He needs to go for a term insurance, because at his age, term insurance is going to be the perfect thing. Not only it is going to be cheaper, but also he can go for adequate risk cover. Ideally speaking, it should be 10 times of one's annual income. He should keep that in mind. And health insurance is very, very important. In fact, anyone who wants to start the process of financial planning should first focus on risk cover and then look at investments.
Investment Ladder, presented by BSC, Investors Protection Fund.
We've absolutely run out of time, Hemant. We'll, you understood the basic contours as far as the mutual fund investment is concerned. We took up the queries which also reflected a whole lot of mutual investments that retail investors have done, and perhaps sometimes right decisions, sometimes wrong. Well, we will be awaiting your feedback on the show, and we will continue to guide you as far as your investments through mutual fund is concerned when we come back for our next episode. Thank you so much for watching.
The Financial Planner, presented by BSC, Investors Protection Fund.